Welcome to the Techno Fundamental Report for August 17th. Nothing gives one person so much advantage over another as to remain always cool and unruffled under all circumstances. Thomas Jefferson. Important quote because you've got to have a strategy with the stock market. You stick with your strategy. Once you have developed a strategy that is repeatable, in other words, you want something that is somewhat dependable that you've studied over the years, and you have your watch list and you just stick with it. Quitters don't do well on Wall Street. Now, I wanted to mention the Dow Jones Industrial Average because I think there's some confusion. A lot of people watch this index, and it's the only index they watch. Now, realize these are 30 industrial cyclical companies. I really think you have to kind of keep an eye on several indexes. We watch 5. Now, you keep your eyes on the prize, you try to do what's right, and eventually you'll reach your goal. In other words, look at this beautiful run that we had back in the 80s. And so if you kept your eye on the ball during the 1970s, early 80s, you were really rewarded with a wonderful bull market that lasted for quite a few years, actually about 12 years. I'm sorry about that. It's about 18 years. So it's worth waiting for the next bull market. The stock market really isn't a gamble as long as you pick good companies that you think will do well, and not just because of the stock price. Peter Lynch. You see, the market doesn't really care. It doesn't care who you are. It doesn't care that you have a position in your stock, that you're waiting for a pullback. In other words, you've just got to have a discipline to deal with these difficult markets. So the market doesn't care. It's gonna do what it's gonna do. It's an auction market. It depends on how many buyers are coming in, how many sellers are coming in. It really just has no emotion. The stock market is a device for transferring money from the impatient to the patient, and Rome wasn't built in a day. In other words, this is a patience game. You've got to be patient. So let's take a look at some indicators. Now, the main thing I want to point out, this market's having a tough time just simply because corporate earnings in the second quarter were not very good. I didn't think they were good. I didn't see any real positive moves on earnings announcements for the second quarter. At the same time, we've got interest rates, and this is a bond fund, the TLT, this is 20. This is the price of the bond. You can see that it's dropping and hitting new lows. The yield on this particular 20-year has gotten up to over 4%, and interest rates and corporate earnings are pretty much the whole ball game. Now you see how we can use the trend monitor that we use. You can see now that we're in the pink on the bond market, which means that bonds are in a downtrend. This is not good for the market or good for anything really. Our country runs on credit, so when credit tightens up, it really does affect the economy. So here's the 5-year Treasury. Now this is our power index. We basically go back approximately 6 months, 125 trading days, and we measure the rate of change. Well, when the yield is going up, the rate of change goes up. So the rule is that if you're above 0, which we are, that's a negative. And as you can see, the 5-year Treasury is basically hitting a new high at 4.4%. So interest rates are not our friend right now. You can also see it here in the 10-year Treasury. This is the highest yield we've seen on the 10-year in quite a while. Oil prices continue to be somewhat in an uptrend, however, have softened a little bit. And the bank stocks, they actually are being threatened with a downgrade by Fitch. And you can see that the bank stocks have kind of rolled over somewhat. New lows are picking back up again on the New York Stock Exchange. That's not a good sign. So we're not seeing a lot of positives this week. In fact, the last 3 weeks have been quite difficult. But anyway, we had 80 new lows the other day. We're above 40. That is a negative. So I'm looking at also the corporate bond funds. This is a high yield junk bond fund. You can see it's somewhat holding up better than treasuries, but still just basically moving sideways. This is the IPO Renaissance Fund. This is a growth fund that deals with the IPOs of the last couple of years. Those are the stocks that make up the portfolio. Trend has really started to deteriorate here, somewhat in a downtrend, broke below the 50-day moving average. You know, the way we look at short-term thinking or short-term technical analysis is we like to use the 10-day moving average. When we break below the 10-day, we want to see basically, and this is the 21-day. We also look at the 21-day and we also look at the 50-day. So what happens is you get a break below that 10-day and then you get a violation below the 21-day. So the IPO fund is in a downtrend basically. Here the bank stocks, just wanted to point out, they too have rolled over. We're seeing the regional banks rolling over here. Again, we need to have a strong financial system, and right now there's some question marks. Utilities, this is also a bond surrogate. This is something that you can use somewhat as a measurement of what's going on in the bond market. So what I'm saying is, as you can see here with the treasuries, on utilities here, they too have gone into the pink. They're in a downtrend. Interest rates appear to be in an uptrend, so that's what's causing utilities to have a tough time. The whole market. Here's the NASDAQ. Again, we just want to point out that we're seeing these indexes. We want to look at more than the Dow. Here's the NASDAQ. It is somewhat rolled over. We're now in the yellow on the trend meter. We have violated the moving averages, and now we are violating the 50-day moving average. So not good. Here's the small caps. You can see the same problem where we basically have just rolled over here and broken below the 50-day. Hopefully we hold the 200-day. Here's the large cap S&P 500, same picture, rolling over, violating. So in conclusion, what I want to say is that the market is probably just dealing with a temporary correction after a substantial rally, but I would continue to be defensive and just sit tight on cash. And if you got a problem stock in your portfolio, you probably ought to let it go. Anyway, let me know if you have any questions. Thank you very much.